In September, the UK ran into financial turbulence again. The pound took a dive, long-term bond yields shot up. And the market immediately started thinking, is Britain heading for another debt crisis? And right at this sensitive moment, Trump personally flew to London, bringing with him an AI investment deal worth hundreds of billions of dollars. Some people are calling this Britain's Lifeline. But here's the real question, is this rope really strong enough to save the UK? Or is it just buying a bit more time? Today, let's break it all down. How deep the UK's fiscal problems really are, how much American AI investment can actually help, and the bigger picture, China and the US fighting over allies in the global game. In recent trading sessions, a few big things happened in the UK. 30-year government bond yields stayed around 5.6% to 5.7%, the highest since 1998. The 10-year yield also climbed to around 4.8%. In August, borrowing jumped to about £18 billion in a single month, much higher than expected. The Bank of England kept rates at 4%, but decided to slow down bond sales. Quantitative tightening cut back from £100 billion to £70 billion. That shows the heavy pressure on both the government and the bond market. At the same time, with borrowing numbers up and long-term yields rising, the pound fell against the dollar. Investors clearly have growing doubts about UK fiscal policy. What exactly is a bond yield? A bond yield, at its core, is simply the return that investors demand. If the market trusts the government, they're willing to buy bonds at a low interest rate. If they think the risks are rising, they demand higher returns before they're willing to hold them. So yields aren't just borrowing costs, they're a thermometer of market confidence. And today's situation is kind of ironic. The UK's 30-year yield is sitting around 5.6%, well above Germany or France, and creeping closer to some emerging markets, like Indonesia's 10-year at around 6.3%. In other words, the market doesn't really see the UK as a safe asset anymore. Investors are demanding emerging market-style premiums before they're willing to buy. For an old major power like Britain, having to pay emerging market prices just to get buyers, that's a crystal-clear warning sign. When yields go up, here's what happens. First, pressure on the pound gets worse. Money leaves, the currency falls, and people even worry it could repeat the big crash of 2022. Second, borrowing costs rise for households and businesses. Banks set mortgage pricing based on long-term yields. If yields climb, remortgage rates could jump from 6% to 6.5% or higher. Millions of households will need to refinance in the coming years. Monthly payments could rise by hundreds of pounds. That's massive stress. Third, government deficits get worse. UK debt has already topped £2.7 trillion, with annual interest payments of £111.2 billion. On top of that, add the commitments to public services and pensions, total debt is now about 120% of GDP. The higher the rates, the faster the interest snowballs, and the harder it is to sustain public finances. It's even more severe than during the financial crisis or the Eurozone debt crisis. And the bigger issue is, it's not just London's problem. The UK is the world's 6th largest economy, and the 4th largest reserve currency. If something breaks, Europe will get hit first. Markets could swing violently, with money flooding into the dollar, US treasuries, and gold. We could even see a repeat of 1976, when the IMF had to step in to rescue Britain. The truth is, the government doesn't have much flexible money to play with. Some analysts say the autumn budget could have a gap of 20 to 40 billion. If productivity forecasts get downgraded, the hole could be even bigger. Without a convincing plan, markets will just keep selling the pound and gilts. In theory, the government has three options: cut spending, raise taxes, or lower interest rates. But healthcare and education can't really be touched. Labour has promised not to raise major taxes. And inflation is still 3.8%, the highest in the G7, so rate cuts aren't realistic. All three roads are tough. And the deeper problem is that Britain has long focused only on saving, without truly creating. The result? Small and medium-sized businesses struggle even more under systemic barriers. Financing is tough, regulation is heavy, taxes are high. Economic vitality keeps falling. Without structural reform to drive growth, the fiscal crisis will only get worse. Possible fixes include rebuilding market confidence. avoiding mistakes like the unfunded tax cuts of 2022. Closer coordination with the central bank, making fiscal and monetary policy move in sync. Issuing longer-term bonds to spread refinancing risks. Attracting more foreign capital, and most importantly, kickstarting real economic growth. Without that, debt can't be solved. In the middle of all this, Trump came to London with an AI investment package worth $310 billion. For the UK government, this is the lifeline. Even if the debt crisis hasn't gone away, at least they can tell a new story. That Britain is still a key hub at the front line of technology. Microsoft is putting in $300 billion to build AI cloud infrastructure. Nvidia is deploying 120,000 GPUs. Google is putting more than £5 billion into data centers and R&D. These aren't small numbers. They can really help the UK. Upgrading infrastructure, boosting jobs and skills, stimulating growth, and maybe even giving Britain a seat at the global AI race. Jensen Huang even said directly, Britain has the potential to become an AI superpower. But AI investment isn't a magic cure. Most of the money flows into US companies. Local SMEs may not benefit much. Energy, regulation, and land use issues still remain. And if the government can't deliver a credible fiscal plan, debt pressure will still build. So the most likely future? On one side, the debt crisis keeps worsening. On the other, AI investments shine bright. Two parallel tracks, moving at the same time. Why is America making a move right now? First, to strengthen the US-UK alliance and keep Europe from tipping out of balance. Second, to pull Britain into the US-led AI ecosystem, exporting its tech and standards. Third, to send a message to allies. If you stick with the US, you get capital and technology. If you don't, you risk getting sidelined. And let's not forget, in recent years, Britain has edged closer to China in some areas. From energy to tech standards, trying to keep ties with both sides. This US move is meant to pull Britain firmly back into the Western core. So to sum up, Britain today is caught between a looming debt crisis and an AI investment lifeline from abroad. But with rigid institutions and constant political infighting, whether the UK can actually seize this opportunity is still uncertain. What America is offering Britain is not just a rope to hold on to, but a window of opportunity. Whether Britain can climb out of the crisis and onto a new stage depends entirely on what comes next. And if you like this kind of deep dive analysis, make sure to hit like and subscribe, and share it with more people. I'll keep tracking the UK, global AI, and the economy to bring you the latest insights.